Here we are. I love that when it cut you off in mid-sentence, just before it happened. By the way, you
You
drinking
know what I
coffee?
was saying to you, right?
What were you saying? To retweet it. Yeah.
Yeah, I'm going to tweet about it, but I'm just looking up here. Powell says efficacy of the dot plots decays between meetings, as if it's effective right when it's released. That's
It's
very
absurd.
effective.
The thing that I've always said is that the fact that the Fed committed to this transparency, and how many years ago was that? 10, 12 years ago.
Yeah,
And they tell us everything they're thinking. Oftentimes, what they're thinking, they're not very good prognosticators of one, the economy, the economic condition, its path, and two, their own maneuvers down the road. They're just not that good at it. I guess, the market still needs something to trade on, and that's why they listen to them, but it's somewhat absurd, in my opinion. You agree?
I do. I would rather hear them say, I don't know, more often than try and put, he just talks both sides. You had kids. Reminds me of like when you're talking to a 2-year-old or a 3-year-old, and like, did you do this? No. You know they're lying.
Right.
You know it. You try to get more information.
There's no doubt about it. And his job is to lie. And like even now, when he says, yeah, we're still in a rate hiking cycle, he will say they're in a rate hiking cycle up until the point where he has to, he sees the burning timbers falling from the ceiling and has to ease, because that's part of the jawboning rates to where he wants them to be. So
Right.
it seems kind of silly to me. But again, we have a guest. We have a guest, one of our old friends and a really smart market guy, the CEO of Prosper Trading Academy, Scott Bauer. Let's bring him in now. I'm starting to look. I know you do, because I'm above him, Scott. He has a problem with that in the graphic that I'm above him, which I think is as it should be. But I'm starting to think that my picture makes me look like the Joker a little bit, with a big stupid smile. I wonder if my photographer actually whitened the teeth on me, because they don't look like mine. But how are you, Scott? It's nice to see you.
I'm great, but am I an old friend because we've been in the business together for a long time, or because I'm older than you guys?
You're not older than us.
Okay, good. That's what I want to let everybody know.
We're both 58. You're younger than us, right?
You just look older than us.
I just turned 57.
Oh, you look like shit for 57.
Okay, you don't have to give your birthday out, but I turned 57 in mid-September, so I'm older than you, right?
No, I turned it in early September. I got you by a few days.
Wow.
Well, I'm a year and a half older than you guys. That makes me sad.
Have you guys ever gone to Viaggio in the West Loop in Chicago?
Love.
Okay. One of my best places in the city.
Meatball salad.
Yeah, meatball salad. That's where my wife worked. I met my wife there, my current wife. And one of the owners of the place, a guy named Dave, he is 2 weeks younger than me. And the interesting part about it is my wife used to call him her second father, and he's 2 years younger than me. He just looks older. He is a prince of a guy, just an absolute prince of a guy, hysterical, but he just has lived a rough restaurateur life. He just looks older, period.
Not easy, especially in that part of the city when you're getting so many people coming in and out before a game at the United Center and the crowd there. Yeah, that's a fast.
And after a game too. That's been in the restaurant business for the last 11 years, and I'm usually in bed by 10. But for people who work late, there's a lot of trouble to get into late in the restaurant bar business. I can attest to that. Yeah.
All right, we got markets going on, right, Jimmy?
Oh, we got markets. Oh, yeah, I forgot about that.
What market? Okay. Wait, was there a couple announcements today?
Today was Fed Day. We were just talking about how Powell either doesn't know what he's talking about or just talks. I mean, he just talks out his ass anyway. Whatever. It doesn't even matter, really. I think the biggest thing that happened today was Janet Yellen making the decision not to sell as many long end bonds because she's worried about volatility in the long end of the curve and not as much appetite. Am I crazy thinking that that's important?
Where do I start? I think we're all in camp on this. I just don't know personally how long Janet Yellen, Powell, the rest of the Fed heads, let's call it, can say that the economy is doing as well as the numbers say they are. Because if you look at Main Street, it ain't happening. GDP at 4.9%. I don't buy it.
Bullshit.
What's that?
Bullshit. Yes.
I mean, look at Main Street, guys. Jimmy, you got to see it at your restaurant.
Yep, we're seeing it. It's at all the last 2 months. All of a sudden, the foot traffic is similar, but the decisions people are making are changing. October to October, we were down 5% in revenues. That's after a 16% rate hike from last October. I mean, price hike for us. And so, yeah, people are making different decisions. There's no question about it.
I mean, are they not taking into consideration that credit card debt is at all-time high, that auto delinquencies are at all-time high, and that the free money of the last few years is gone? That is gone.
Savings rate is below pre-pandemic levels now.
Exactly. And I don't want to sound like, this is Armageddon. It's not. But these guys got to wake up. They just have to face reality. And
right. So, but the point, I think what we're all saying here, correct me if I'm wrong, Scott, is that the numbers are like, even that unemployment number from before, it said we increased by 100 million whatever jobs. Realistically, in the last 3 months, 700,000 of those jobs are government jobs. 1.2 million private sector jobs have been lost. Part-time jobs are going through the roof. Full-time jobs are cratering. The problem we all have is that Scott Bauer is seeing that things are deteriorating, and the Fed is saying it's not deteriorating. The federal government is saying it's not. That's where the problems could happen. They have room to address it, right?
There's no question about it. And I have to be honest with you. What he said today, he basically, not, everyone's saying that he took last month's speech and said the same thing. He basically just hid behind the fact that everybody knew they weren't going to do anything with rates today, and just pushed it on down the curve a little bit. And listen, I don't mean to sit here and bash Jerome Powell, right? Lot smarter guy than I am. Well, maybe not, but when it comes down to reality, guys, what the hell are they doing? What the hell are they doing?
Scotty, let me ask you a question. I've got the statement in front of me, and you're right. There's a grand total in the statement itself, not counting the change of the date. And there's 1, 2, 3, 4, 5 changes in the wording, and they're very slight. But the one that struck me was they went from tighter credit conditions for households and businesses are likely to weigh on economic activity to tighter financial and credit conditions for households and businesses are likely to weigh on economic activity. Take a little walk with me. Jim, I'd like you to answer this too. I see that as a direct nod to the long end and how they're going to let the long end do its work if the long end stays high, which again goes to, Jimmy, what you're saying, to not sell longer end treasuries today was just dumb. But I think that's a nod because it's financial and credit conditions, financial bonds, treasuries, interest rates. And I think he's saying there that they're moving toward yield curve control. And the reason I say that is because I think Jimmy and I think this, Scott, I don't know if you do. The first ease is going to come in the form of quantitative easing somewhere. And if they're not doing an announced program of quantitative easing, that is yield curve control. So am I crazy? Am I just trying to find something in a statement that isn't really changed?
No, not at all. And in addition to all of that, or maybe instead of, or at the same time, the 2% target, I'd be betting a lot of money that by this time next year, and probably even by second quarter next year, it's no longer a 2% target. It's going to be 2.5%, maybe even 3%. And maybe they will kind of back into what they want to do and get inflation down and get the economy where they want it by raising up the target. Because 2%, guys, that ain't happening in, I don't know, the next, probably before I have a grandchild. Let's put it that way. I don't even have a kid married.
I've heard they don't have to be married to have children.
That's very true.
I don't know, I learned that in a book at one point in time. Bobby, I'm going to ask you, I'm going to throw the question back to you, Bobby. Is there a chance that they had a statement that they were working on yesterday, the day before, All of a sudden they see that crappy ADP number. All of a sudden they see that crappy PMI number. All of a sudden they're like, shit, rip that up. And let's just alter the one from last time just a tiny bit instead of the new one. It's possible, right?
I totally agree. I think that's likely. When you look at what changed, let me give you an example of a couple other things that changed other than what I just said. Recent indicators suggest that economic activity expanded versus has been expanding. Okay. And then expanded at a strong pace versus a solid pace. These are the changes they made. I mean, I understand them saying expanded versus expanding because you just mentioned the crappy numbers we just got.
Yeah.
It's difficult to look at PMI, manufacturing PMI, where every part of the manufacturing PMI is in contraction and inventories at the lowest level since 2012, and say that it's expanding at a strong pace, right? So I totally agree. I think that's exactly what happened. Maybe they did it last night. I don't know if we believe that they get advanced copies of numbers or not, but I would think that the manufacturing PMI wouldn't be one they would ask for, really.
I mean, they have to have multiple iterations of what they're going to say, just like whatever the announcements are going to be or the rhetoric's going to be Friday after the jobs number comes out. There's got to be 2-3 different iterations that they're ready to say based on.
Of course, that's a great way to put it. That's probably the exact thing that they do. Like they're not like they're caught off guard. They know they're going to see new data. That makes sense. Scott, we had Mike Singleton on last week, and he painted a picture like just the last 10 years of equity market returns had to be juxtaposed against zero rates along the curve. Now automatically you're sucking 5% of the attractiveness of stocks out for the next 3-4 years.
Yep.
So when you look at the next, like say 3 years, do you think the stock market's going to suck and trade heavy?
I do think at least for the next few quarters it will. And quite frankly, I'm surprised that the market is where it is, that it's not lower. I think that is either a testament to people looking at charts, people just being optimistic, people believing the economic numbers, because given all the headwinds, given the data that's out there, given all the geopolitical risks, I don't know why the market isn't lower. And so, that
could it be that a lot of people were short already? I mean, hedge fund shorts
no
are
doubt
quite high.
No doubt, but now throw into the fact that you get 5%, right? You get 5%, go to sleep at night and wake up in the morning and you're still getting your 5% without risk of losing any money there. Boy, oh boy, that is compelling, especially coming where we've been for the last, I'm not even going to say the last 5 years, but the last 20 years. I mean, I can't remember interest rates like this really, and they probably have happened, except back when I was trading on the floor, in the early mid 90s, and you get paid 7% on your short stock interest. Yeah, it's compelling. It is compelling out there to just sack it away for a while.
That's back in the day when you actually had to have interest rates in your Black-Scholes model.
Yeah,
because they mattered.
We talk about that all the time.
I forgot what is even the Greek letter that was for interest rates.
That would be rho.
Rho. I forgot what it was for the last 15
That would
years.
be rho.
Now I have had to learn it again. Rho. Right. Okay.
So, Scotty, I want to talk to you about earnings here a little bit, if we could. When going all the way back to the time when Jim and I were on the futures floors and you were on the SIBO floor, what is it still the case that the first move, and I don't want to make this 100% blanket statement, but is it often the case that the first move post earnings isn't necessarily where the stock is going? We had open interest in the equities fall the last 2 sessions. I obviously don't know what happened today, which leads to Jimmy's conversation that it might be short covering. But is it still the case? It's still the case with non-farm payrolls, that the initial move on non-farm payrolls is often not the right one. Is that the case with earnings announcements as well?
I don't really see that, to be honest with you.
Okay.
I think when we get that move, especially when it's a bigger move, a big gap move, I think that does tend to follow through. It certainly levels off a bit, but I think that tends to follow through at least for a couple weeks. I honestly do, unless there's something that really hits the market that's going to make the overall market turn in the opposite direction. So I think the momentum post earnings is pretty positive for a stock, whether it's to the upside or to the downside. That continued momentum, I do think it stays there for a bit.
That was going to be my next question, Jimmy. Is it different from the upside and the downside? And you're saying it's pretty similar.
But like, why? AMD beat, got crushed. Caterpillar beat, got crushed. Is there trends this earnings season that is it all about when they come on the call and say, yeah, we think things are going to suck going forward? Paraphrase. Is that what's happening to these stocks?
There is a lot about guidance, because the numbers themselves, if you didn't take out it, or if you remove the commentary, the numbers overall, at least from a top line standpoint, have been really good. It is the guidance, and it is lack of guidance as well. There's been a lot of companies that have come out and just won't give guidance, which is just as bad as giving bad guidance. So that is really the focus, right? The absolute top or bottom line has been somewhat irrelevant. Obviously, you want to see the health of a company, but it really is about guidance. But you know what? With this earnings cycle right now, the expectations have been really, really low coming in. And for most of the stocks, I want to say going into today, I think it was 78% of the S&P 500 stocks had beaten expectations. But I take that with a grain of salt, because those expectations were lowered so much coming into the cycle.
I'm going to give Jimmy a break here, since his licensing doesn't allow him to talk about individual stocks, and ask you about 3 specific ones. The first one I want to ask you about is NVIDIA. And the reason I'm asking about that is because, and we don't have to talk about the other thing, I think Bitcoin's having its NVIDIA moment. And what I mean by that is rocketing up on the ETF excitement. And then once 1 or 2 or 9 of them gets approved, the actual participation in those ETFs and the fees and the fight over which one is better is actually going to slow the momentum a little bit. And I think we're going to get similar to what we're getting with NVIDIA right now. How do you feel about NVIDIA overall? And you could take 3 months out, 6 months out, or 3 days out. I don't care.
So to me, NVIDIA is a great trader. Longer term, it's tougher for me to say I want to hold this stock for the next 2 years, 5 years. It's a great trader. What I love most about trading a stock like NVIDIA, and there are others, is it's always in the news cycle. So take, for instance, was it Monday, or was it for end of last week, when the news came out about some of the Chinese stocks and AI, and something specific comes out like that, and you see NVIDIA get massively hit. To me, that's a really big buying opportunity. The same goes in the opposite direction. When there's some big news event that really pops a stock, I'm usually contrarian, and I like selling into that. The same thing happened with Meta a few weeks ago about the new all the AGs, the 400 AGs that went in on a court case, a lawsuit against Meta, and the stock got annihilated for a day or two. To me, that is always an opportunity to trade it, not as an investment, but to trade it. I'll be quite frank with you guys. I am not an investment advisor. I am not a portfolio manager. I learned a very, very long time ago, the hard way, that I could not trade my personal long-term portfolio, and I had to just let my investment manager do what he wanted to do, because I effed it up so badly. So do I have opinions? Yes, but I don't trade it. I don't look to say, I got to hold NVIDIA for my retirement account. That's just not me.
AMD. Can I ask you about that one? There's a lot of people that think AMD is the opportunity. They look at AMD as to NVIDIA the way that they look at silver as to gold. Do they have the same sort of opportunities? It's the same sort of thing. And let's stick it to a trading perspective, since that's what you do.
And you know what? Look at what happened today. The results came out last night. The results were good. The guidance was not. Mm-hmm. Okay. And the stock got fairly walloped after hours last night, for whatever reason. And the only thing that I could really see that happened today is they started mentioning AI a ton. The stock is now up almost 10% on the day from being down 5% last night.
Yeah,
Jesus.
9.25% right now. It's crazy.
Yep. It's trading 107.60 right now. It traded down into the almost 90 last night. Now, the overall trend for AMD for the last 6 months, much like the rest of the industry, has been down. We've seen lower lows, lower highs. Longer term on this one, I think that AMD has a higher potential return than NVIDIA does.
So
Risk adjusted?
What's that?
Risk adjusted? Well,
Risk
you always do. And you always do limited risk options, right? For the most part.
Yes, risk adjusted. So for instance, let's say AMD is 110 right now. I'm just kind of rounding it off. If it goes to 150, that's a 36, 37% increase, where NVIDIA, which is trading 420 right now, for that same thing, you're talking about a 550 print on that. So I do think AMD has the potential over the next, I'm going to, even shorter run, not 5 years. I'm going to say next 6 to 12 months for a bigger pop than NVIDIA does.
Okay. And this, I have actually kind of two questions, but to your thing about NVIDIA, again, like Bobby mentioned my license. I'm not recommending anything. I'm just trying to refine what Scott said. When you said it's a trading vehicle, that to me sounds more like you think, dude, it's been running like it's been running out of the gate for so long. It's probably a silly time to bank all your investment money into it now. That's kind of what you're saying, right? Now it just needs to be looked at as a swing trade, right?
Absolutely. To me, 100%.
Okay. Then I wanted to talk.
And you get a lot of pundits on TV. And I guess we're some of those pundits.
The three of us are, yeah.
that will say,
those assholes, yeah, right.
Especially with a stock like Apple, don't trade it, right? Just hold it. I think it's the opposite for NVIDIA.
Okay, that makes sense. Now, can we move on to gold?
Yes, please.
I love. What are your thoughts on gold? Go.
So I wrote a piece for the CME at the beginning of October, and it was about gold when gold was trading in the 18 handle, and it was about option premium and where the retail paper was going with it. And there was such a decided advantage to put options over call options because that momentum was to the downside. Then we got what happened in the Middle East. Everything blew up, and that entire curve shifted, where now the skew, and it's a pretty major skew, is all to the upside. It's all to the upside. Now, 2000 number, nice round number. We know the market likes round numbers, whether it's gold, oil, an equity, doesn't matter. The market likes nice round numbers. I think gold has some headwinds coming in. Unless we see a protracted, more protracted geopolitical risks. That to me is what has propped up gold.
Okay, Bobby, I want you to take the next question. I just want to, like a lot of times we say, particularly in interest rates and in gold, when we say the market likes nice round numbers, it isn't just a psychological thing. A shit ton of options are written at those nice round numbers. Because if you're looking at long-term options from 6 months ago, you're not going to say I want the 1978 options. You're going to say you're going to say the 2000 options. You just make the assumption. So that's why. And then like yesterday, I don't know if you noticed that the gold spot has never closed a month above $2,000 ever, and it almost did yesterday, and then got pummeled into the close, lost like $15. So to me, that's kind of wild, and I think it's options related. But Bobby, I just wanted to add that.
No, it's okay. I mean, just to comment a little on gold, from my perspective, we're seeing gold basically near its all-time highs, right? I'm looking at the gold futures contract in a situation where everyone expects the Fed to cut rates, and a lot of people expect the Fed's trip to 2% inflation, of which the three of us agree he's not going to get there very quickly, to be what he called bumpy. And today, Powell called it bumpy. He said the road to 2% is going to be lumpy and bumpy, or something to that effect.
So is that going to be the new transitory?
Yeah, it is. And by the way, inflation's been above 2% for like 2.5 years now. Yeah. So what happened to transitory? But yeah, that's going to be his new thing, is that the trip back to 2% is lumpy and bumpy. And I don't I said this on the show before, Scott, that my trade of the year was gold. And I said it on a show in November of 2022, and I'm completely happy with where it went. I had people reaching out to me on Twitter and elsewhere saying, "Yeah, you should have said it was NVIDIA." Ha, ha, ha. Like, you don't get what I'm saying.
Thanks.
You don't get what I'm saying. They're different vehicles for different purposes.
Right.
But I'm going to stop rambling and ask you about Apple if I could. One of the things I like Apple as a hold, and you already mentioned it, like with something like an Apple, that's a hold stock, something like NVIDIA, it's a trade stock. Apple, the last 3 days has kind of rallied, but the volume is slipping, right? It just keeps going lower and lower and lower.
Yes.
When you look for options trades, it doesn't have to be specifically on Apple. Do you look at volume at all? Is it a part of your metrics or no?
So I look at volume to make sure there's enough open interest that myself and my students can get in and out real easily without slippage, right? I don't want to trade. I don't want to put a trade on where the bid ask is 50, 80 cents wide, $2 wide, because yeah, maybe you can get in, but when the shit hits the fan, can I say that?
Yeah,
sure.
When the shit hits the
Fuck
fan,
yeah.
I got to know we can get out, right? And so if you're trading in something without the liquidity, I pass on it. So even though Apple volume over the last week, several weeks, has been much lower, the liquidity in terms of trading the options, you're still going to get the tightest markets in the world, and you're still going to be able to trade it. Now, looking at that, though, in terms of what is the retail interest, that's a different story. That paints a slightly different picture in terms of, well, maybe people are moving away from Apple. Maybe there's other vehicles in the marketplace now that are replacing Apple that people are interested in. So I think you have to really separate the two. From a trading perspective, volume is imperative for me to make sure I can get in and out without slippage. From a longer term perspective, it has a little slightly different definition.
So I've called you the Chuck Norris of options in the past. Can you go through, that's a massive compliment. I don't know why you don't have a huge smile on your face.
I'm holding it in. I'm holding it in.
Can you go through what you look for in a trade? You do a lot of spreads, a lot of contained risk trades. What do you look for when you're constructing a spread, and what's your favorite kind of trades to put on?
So my absolute favorite, if the option gods in the world said, Scott, you can continue trading, but you can only trade one type of strategy, it would be time spreads, calendar spreads. Whether it's on the call side, put side, I love time spreads because there's typically the opportunity to take advantage not only of direction, but of volatility, of a mispricing, if you will, in options. And when I say mispricing, I don't mean that anybody can look at the markets and say, oh my God, this option is way too expensive or this option is way too cheap. Those days are gone from when we used to be back down on the floor in the 90s, right? Because the option market and the overall market is so efficient right now. I am typically looking at time spreads because it gives me so much flexibility to do something, because I'm not always going to have the right call. I'm not always going to have the right position. I could choose to bail out, take my loss, or I could choose to do something else against my original position. So, for instance, in full disclosure, we had a time spread on in MPC, okay, with earnings out yesterday.
Scott, can you explain to the people what a time spread is? And by the way, explain to me, are you saying that the option you sell has shorter duration to take advantage of theta?
I'm always long time spreads. I am always long.
Okay, yeah.
So calendar spreads or time spreads they're one and the same. That's exactly what we're doing, is we're creating time. So in the case of MPC, when the stock was trading at 146, 147, I was looking at the charts. Things were, to me, bullish, coming off some moving averages. I was looking at an upside move. So let's say I'm bullish. All right, I want to buy a call option sometime out in the future, whether it's a couple weeks, a month, 6 months, whatever it is. So I buy that option out here in the direction that I want. But to finance the purchase of that option, to reduce my overall risk, I will sell that like option with a shorter expiration date to it. Take advantage of what's known as the theta. We were talking about Greeks before. Take advantage of the option decay, while I let my long one marinate for a little bit. And then it allows me the opportunity to roll out, to maybe sell another option. So in any event, MPC stock went to 157 today. That was my strike. So we had bought this option spread for 90 cents, which in option terminology, every option or every spread, multiply it by 190 cents is 90 bucks. We took out half of our position yesterday. We sold at $1.40. We sold the balance at $1.90 today. And the dynamic to that was twofold. One, I happened to be right on the direction of the stock. So it was a bullish play. Great, stock went up. But we also took advantage of that short-dated option disintegrating, while the longer one held value or actually increased in value. So to me, my specialty is trading volatility and is trading time. I would much rather trade something like that than just a pure directional trade where, I got to be right or I'm wrong, or I'm cutting the trade out right away.
So you're talking about same strike, right? 157
in the
versus
calendar,
157.
same strike.
Yeah.
Calendar, same strike. Now, we happen to do another one that we took off yesterday in Pinterest. And we're obviously talking about all equities here.
Sure.
It was same idea. We sold an option expiring this week, bought one expiring in 2 weeks, but we used two different strikes. So we had sold the 30 strike and bought the 28. What that did is it gave me time. It gave me a big volatility advantage, but it also gave me extra direction, extra delta, because I basically had a 28-30 call spread on, but in addition to the time. So, depending on reward and risk and depending on pricing and what the implied vol differences are, that really will make or help make the determination whether I use the same strikes or different strikes.
Okay, this is interesting. So I was on Charles Payne 2 days ago, and he asked about the levels in the VIX and if there's anything that I saw from that. And I said, over the last, call it 20 years, big real reversals, bottoms are found generally with spikes. Call it 35 was my thumbnail, and we're not even close to that in the VIX. But here's my question: options trading has exploded on the retail level in the last few years. Those 0 days to expiration, they're all over the place. So many people are using it. Has the involvement of a different class of trader done anything to the vol signals at all, in your opinion? Or have you ever even thought about this, or no?
I think more so over the last year or so with the advent of zero DTEs.
Yeah.
Because what that has done is it's taken a little bit of edge off of the VIX. The VIX is still tried and true. I trade the VIX all the time. But when you have these zero DTE options now in the S&Ps that literally can expire in a matter of hours, I think a lot of retail that was taking an opinion by trading the VIX, whether a bullish, bearish position, have now shifted a little bit to the zero DTEs, because just like everything else, a lot of people want the immediate reaction, right? They don't want to put on a position that maybe is a week, 2, 4 weeks out, whatever it may be. When you can get the bang for your buck, if you will, in these zero DTEs, not without risk. Certainly, you've got to know, you've got to be a seasoned trader to trade those, in my opinion. You've got to know the risks, that those premium levels, right? Like we were talking about in the two trades I talked about, those premium levels, because they expire so quickly, they collapse immediately.
Okay, so here's something that I just thought of right now when you were talking about time spreads, and I love picturing the windows where they will decay the fastest. And one thing that's always annoyed me, when it gets like a day or two out, the decay starts to slow down in certain respects sometimes, because particularly if they look like a lottery ticket to somebody, if there's something, and maybe there's a binary event. And also, could these 0 days to expiration, just the last couple cents, because people are still buying those that day to trade them. So that might be elevating and keeping that last little bit of sucking away the theta away, right?
So this is a really good analogy. You bring that up. What do all the shipping companies out there, what do they say is the hardest dollar to capture? That last mile.
Right.
Yeah. to me, that's analogous to saying that is the hardest to capture is those last few pennies, though that last dime of an option that is close to expiration, that is decaying, because even though the theoretical value of that option may be zero, there's still, like you said, someone holding it for a lottery ticket. Someone doesn't want to be short that option. There's no question about it. That is the hardest.
So
to capture.
you tend to take those off then if you get the opportunity to within your spreads, right? That's what I like to do.
Yeah. Absolutely. I am so risk averse. I rarely will let an option just fade away.
Right.
I want to know that, God forbid something happens after hours that I can't access the market, whatever it may be. I'm going to take that off.
And you forgot you had those on. This has happened to me before. Like, oh shit, I had those on. Right. Yeah.
No doubt.
That's funny, because that's actually where I was going to go with this. I was going to ask you, it's like I've been a subscriber of yours, and I always see the exit signals, and I wondered if you ever just say, we're just going to let this one expire. I know when I talk to Jimmy, he's generally he'll give when we're talking about futures options, he'll give an options trade that he's in, and he'll go, and I just want to let everybody know I will probably be out of it before the maximum profit hits, but that's the kind of thing we're doing. And it seems like you're nodding, so I know your answer to that.
Yes.
But how do you sort of like game out or plan out your sort of longer term reward to risk? Do you make sure that an approximate exit is going to fit your strategy? Is that how you do it?
Yes. Yes. So we actually have pretty rigorous reward to risk guidelines. Everything has to be flexible, obviously, given market conditions. But we have pretty rigorous reward to risk guidelines, and both on the plus side and obviously on the losers, right? For stop losses. And when we get to those areas, especially on the reward side, we will take half off, reduce our risk. And if we're going to remain in a trade, we will always have a really tight stop with it.
Yeah.
Otherwise, though, you know what? Maybe I'm leaving money on the table. I know I am. Let me be frank. I know I'm leaving money on the table, but what I'm doing is I've hit my goal. I know over the long run, right, for doing this for 35 years and, hundreds of thousands of trades, I know the probabilities over the long run. So if I've left something on the table, so be it. But I've now taken that money and I'm now going to allocate it to something else.
So what do you like right now? And I'm not asking you to give people a free trade. No, I don't mean that. I mean, like, I know you're looking at screens while you're talking to us. So am I. So is Jim, because the markets are still open.
Yep.
Is there anything on your radar screen right now? And by the way, full disclosure, I don't want people to trade it just because Scott said it.
I don't think he heard you say small caps though, Scotty.
Yeah.
So
I thought you said all cash.
No. I said small caps.
I'm here. I speak Scott and Bob, so I can negotiate.
Well, that's because we're only about 10 miles away from each other, and Bobby's basking in the sun.
Yeah, there's a little bit of a delay here. A little bit of a delay.
What's that?
Because you're in Chicago. You
and I are about 10. Yes.
Oh, yeah, 10 blocks away from each other. Right. Okay. Okay. Yes. Go on.
I think if we're going to have any sort of year-end rally, and maybe we do, maybe we don't. I think small caps have the largest to gain, just because they have been beaten up the most. I don't necessarily advocate being in, calling your investment advisor and piling into small caps for your 401ks or anything. As a trade for the next 6 to 8 weeks, if there was one sector that I'd want to be in that I see with the most upside, it would be in the small caps, whether Russell, IWM, take some sort of few stocks that are in there, whatever it may be.
Do you back that up fundamentally, or is that just look at moving averages, look at technical setups?
It's more technical. Be honest, it's more technical.
There's nothing. Bobby and I are mostly technical. We make that point all the time. We use fundamental analysis to buttress, but
I think fundamental analysis a lot of times, and it's obviously valid. You can change the fundamental to make the situation fit.
What we do.
I'm not,
yeah, we do that.
Right? I mean, we have to look at it. It's part of
Yeah.
trading. It's part of investing. We have to look at it. But I'm more technical than anything else.
Can I do this, Jim? So Jim and I have talked about this on our regular podcast, on this show, on other shows, where we both say the same thing. We'll see something on the chart and then kind of sit back, and we do it in different ways, but it's the same thing. We sit back and go, wow, this looks like it's heading lower. Why would it? And then that becomes my fundamental opinion.
There you go.
As to why would it? And the interesting thing is that Jim mentioned Mike Singleton, and we get his newsletter. In his newsletter this morning, he talked about how fundamentals are basically technicals. Like he said, for example, if you have an idea that Netflix, this wasn't his example, this is mine. If you think Netflix has to have 10 million subscribers and they get 8 million subscribers, so they're 20% short, that's math, that's numbers, that's technical. That's not you saying they have really good movies, so I want to buy Netflix, which is fundamental. Warren Buffett's fundamental, right? I like McDonald's. I like Coca-Cola. But even the way a lot of these guys do it, where they think, they say things like EPS is here and forward earnings is here. To me, that stuff's technical. It's just not charting.
I also think when you get into fundamentals, you're looking more at investing than trading. Mm-hmm. At least for me. I know that the type of trading I do, I'm putting on positions that expire in real short periods of time. Not necessarily day trades, but I'm looking 1, 2, maybe 4 weeks out on the long end. And I think when you start to factor in fundamentals, if you're going to trade off of that, you have to take a longer time frame in your thesis, because just because fundamentally something looks bad doesn't mean the stock is going to go down tomorrow or the next day. So I think you have to let that marinate a little bit longer, and that's just not my style of trade.
So I have a quick question to both of you. Warren Buffett claims that he drinks 9 cherry Cokes a day. The reason I know that that's not true is because he's not dead. I'm right, aren't I? Anyway.
You're 100% right.
Yeah, of course. He's just trying to sell Coke. It's what the guy does. Drink Coke.
Funny story. I don't know if you guys know this. In my early days on the SIBO trading, Coca-Cola was one of the stocks that I traded. It was in the pit that I traded in, along with Bank of America, Whirlpool, a bunch of other stocks. And every year in January, Warren Buffett would send in an order through Goldman Sachs, who was his preferred broker. And he would literally buy tens of thousands of out of the money puts, usually about 15, 20% out of the money every year. He wouldn't close them. He would buy them every year. And we knew the order was coming in. Why was he doing that? Just hedging his gazillion shares of stock that he had. So, that was always an opportunity for us to sell a little extra premium. I mean, not that I'm a big believer in selling those, outside wings, but just you brought up Warren Buffett, so I had to bring that up.
No, I think it's definitely interesting. I mean, it's this. He should have called the people at Silicon Valley Bank and told them to do that with their hold to maturity portfolio.
God almighty, that's the most frustrating story on the planet, isn't it? It literally is a 10-minute phone call that we could have had those guys covered. Yeah, we'll buy you some 10-year push spreads. You're going to be fine. Sleep well tonight, dipshits. Yeah.
Exactly.
Or are they dipshits? Do they just know? Like, are they just partying, not caring about the hangover? That's what I sometimes wonder about these guys too. Like, yeah, someone's going to come in and bail us out, which didn't really happen. Did it? Whatever happened with SVB?
They got bailed out. They're still
SVB out.
They're still.
But the First Republic got bought by J.P. Morgan, right?
Right.
Even though it was completely against the law, because something about their deposits, there's some banking regulation, and the FTC was like, don't worry about it. Just or FTC is it the FTC? Don't worry, just get it done.
We're in panic mode. Just get it done.
Okay, let's talk about banks real quick, and this is probably more to Bobby and what I want to know Scott's opinion too. I have contended that the big banks are trading with they're almost like utilities at this point in time. Now they've said, Janet Yellen came out and said, oh no, if you're a systemically important bank, we're going to protect everything. And Bank of America, they talk about them having a shit ton of those hold to maturity bonds. And if they were called onto the carpet right now, might be insolvent. Yep. What do you think? Yeah. Have you been trading that stock at all or no, Scott?
Not Bank America. In the banking sector, there's two stocks that I really focus on. Just that I have just everybody has their nuance, right? J.P. Morgan and Goldman Sachs. They've been really good from the option standpoint, trading. You look at technicals, especially in those two stocks. Although now I full disclosure, I am long some J.P. Morgan because I got down to some major 200-day moving average technical area. So I'm long there, which I don't mind it. So I really haven't traded in Bank America much. But yeah, you're right. If you looked at that and you didn't have the knowledge of what Janet Yellen said, you're right. That stock could be gone tomorrow.
I look at that as a relative thing. Like Bank of America, if they end up being insolvent, I mean, I think it's pretty fair to say they're going to get bailed out. And it reminds me of when people were going crazy when Western Alliance was on the ropes, right? And they were saying, oh, you should just buy that because it's going to be a double or a triple or a quadruple. It did end up being a double.
Yeah.
But if you got it on the very bottom. But Bank of America, I say, people call me, should I do this? Should I do them? Like, they could close. Like, I don't think Bank of America could. At least I don't think they would let them. I think they should if they're in bad shape, but they have no courage for economic pain at all. And I mean, I guess I get that because their jobs are to get reelected, not to get things fixed.
Sadly, that makes me sad. Can we pivot to Bitcoin? Do you care about Bitcoin, Scott? Do you trade it? Do you own it? Do you like it?
I do.
So best performing asset this year, up 110%. Mostly just broad adoption by the big names, particularly our overlords, BlackRock. Every time we mention BlackRock, I think we should do this, right? Scott, you're independent. I still think they have the power to fire you if they got pissed at you. They just call you, Scott's fine. But I don't work for you. Yeah, you do. Everybody does.
Everybody.
But anyway, so Bitcoin to the moon. Are you a hodler?
I mean, yeah, I have some. My kids have some. They don't trade crypto. We just have some funds, and I had traded it for a while, and I'm probably not going to get rid of it. It's an investment to me that we've had for a while that if it went to zero, I'd be really pissed off, but wouldn't change my life. Yeah. And that's how I look at it still. I think actually if and when, and it's probably when, not if, the day comes that there is an ETF that is approved, I'm just wondering if that's going to be a little bit of a buy the rumor, sell the news event.
Do you remember when the futures contracts were launched, right?
Sure do.
$20,000, and they immediately started to because it gave people the opportunity to hedge. That's what Scott's saying. I didn't mean to cut you off. Yeah.
No, you're exactly right. You're exactly right. Now, if that does happen and it gives everybody so much more adoption and access and everything, are we going to 100, 150,000 like all these, It
was Templeton, wasn't it?
Yeah, someone said 150 today by the end of 2024.
Yeah.
I mean, I do like it. I don't, is it going to change the way that the world works monetarily? Who knows? Maybe 20 years from now. I don't know. I do think it's worthwhile for someone to have in their portfolio. Again, if they can look at it and say, I'll be really bummed if it goes to zero, but it's not going to affect my daily life.
Scotty, what is your opinion? And I was going to ask you this before, but we went off in a different direction. For the average trader that's watching this on these zero DTEs, what do you tell them? And I'm just going to let you answer because I drank too much water. Take that for what it's worth. I'll be right back.
Make sure the mic's off.
Make sure the mic's on. No, I like that question a lot too. Do you find value for retail traders in zero days?
If they understand the risks, yes. I think it's a phenomenal way of hedging an event. A Fed conference today, the jobs number on Friday. Maybe even an Apple earnings tomorrow. Because if you're going to get something that has the potential of a market move, yes, I think zero DTEs are great. I think it has.
By the way, how much money have we cost you by sitting with us? The S&Ps are now up 1.3%, 55 points on the day. So you sitting with us, my opinion is probably that you cost you a shit ton of money. No,
It's a good thing I forgot to put my stops out there. No.
man, I couldn't get out of my own way today. And again, I always say that I'm an okay day trader, not good, but I make money over like 2 week time frames. And today I was a little bit bored waiting for the Fed, so I became Mr. Day Trader in my head, and I got shellacked like 5 times in a row before I clawed back a little bit. So extremely frustrating, but yeah.
No,
So,
I definitely hear you on that one.
yeah,
Back to the zero DTEs, I think they're I love them. I understand them.
of course.
You understand them. I understand the risk to trading them. But for someone that wants to put a position on for a specific event and they want that immediate reaction, they have the ability to do that. But again, it absolutely comes with the risks on both sides. From the long side, it comes with the risk that if you don't get your move, that premium, that is going to be sucked out of it before you can take your next breath. From the short side, if you don't understand the risk, the premium that you think you're collecting that you're going to keep because, oh my God, I can't believe there's, X amount built in for only 4 hours left of this trade. If
Good
you
luck.
get a move, well, you better have something against that.
I think that the theme, and we try to hit this all the time, is one of the reasons I love options is because you can fully define your risk. And people, it's such a weird marriage out there because as we've seen in so many assets that are traded like NFTs and artwork and weird shit, people do dumb things with their money. A fool and his money are soon to part. But the proliferation of options to me, I think, is encouraging because we would all love when we put in our job as educators of people, and we get paid money from different brokerage houses to educate people how to use things. So we become quite staked in it, Bobby, and you do it professionally, obviously.
Yep.
And I would love to see people increase their exposure to options and understand their risks. But you still do see a lot of cowboys who are like, wait, I can buy 100 of these 0 day. You still see that, right, Scott?
Oh, there's no doubt about it. But was that a promo for my company?
Well, actually,
can we
do this?
We're always doing
Hang on,
promos.
can we do this? So I have a question that's sort of along the same lines of what Jimmy just said. And I would like to politely ask you to answer the question in this way. Before you give your answer, give where everybody can find you, because we always forget to do that and then the show's over.
Sure.
But the question is, people fall prey to what I call the Madoff syndrome, right? Where they start making money in one thing and then they just dump everything in there and they pile in a strategy. And next thing you know, I have a relative who said to me, yeah, I used to make a lot of money selling options, but it's rigged and I lost everything. No, it's actually
rigged.
not rigged.
It's not rigged. You're a lot of that.
You're a knucklehead.
Not rigged.
But how do you, because I know you personally, right? And I know you're the person who's saying, if someone says, yeah, I'm dumping all of this into your program because you guys don't manage money, but you say, I'm dumping all this into your recommendations, you be the guy to get them on the phone and go, don't do that.
Right.
So where can everybody find you and how do you fight off the tendency of your clients to do that?
Okay. So number one, Prosper Trading. So it's prospertrading.com. And what we do is myself and other real traders, when I say real traders, we're talking about guys that have been in this business for years and years and years, that had time on the floor, that have experienced things from the ground up. We are trading with and teaching people live in the markets 8:30 to 3 o'clock Central Time every day, whether it's options or stocks, whether it's day trading or more position trading like what I do. That's what we do on a daily basis. It's live, virtually, but live in our classroom. It's a community. All the students get to interact together. So that's where prospertrading.com. That's where you can find us. Now, first and foremost, and Bobby, since you get the signals, you'll see it. On every signal that we send out, and we preach to this, just never ending, is we recommend, we can never tell people exactly what to do. We recommend to anybody 2 to 3% allocation on any one position. Okay. Don't fall in love with any one position. What they ultimately wind up doing, that's on them. But we have to do that, right? Because as you said, if you start piling in, if you say, man, Netflix is going to 450. And, I'm taking everything I have over here and I'm buying some calls in Netflix. That is the fastest way out of this business that you will find.
And guys, we've seen it a million times for these
Yep.
people who are watching out here. This is one thing that's been consistent for my 36 years in the business is people are like, wow, I'm a genius. And then guess what? They're gone. Bulls make money, bears make money, pigs get slaughtered, right?
No question about it. So we really harp on risk allocation, and we tell everybody it's in every one of our signals, 2 to 3%. You want to do, 5%, that's up to you, but stay consistent. Because if you don't stay consistent, it's going to be that one that you say, man, this is a no-brainer, right? Where you're going to put 10% in, and that's going to be the one that loses. So
Okay.
I have to go. I have to be at the CME at 3, and then I have a flight to New Orleans for that speech tomorrow in about 3 hours. So you guys, is it okay if I just bail out and you got to
go. I'm going to tell one more story.
Wear that Illini jacket, absolutely.
Damn right. By the way, this Illini basketball team is as good a basketball team as I've seen since 05. I don't know if you saw them mop the floor with Kansas in the exhibition game the other night. That 2 fights started out, and so these kids weren't taking it as an exhibition.
I will definitely be going to some of the games this year.
Awesome. You were a graduate?
Proud alum.
Same. 80.
I think I'm going to wear my Purdue shirt next time you take it.
Next time you're down there, Jimmy, next time you're down there, go to the business school. They have a trading lab. My Goldman Sachs trading coat hangs up in the trading lab.
That's
awesome.
Outstanding. Good. Thank you, Scott. It was so good talking to you.
You too.
Yeah, I was just going to tell you a story that one of my very first, educational signal services, we, told people that we're trading one specific strategy that historically has won about 67% of the trades. And that history was about over 10 years. And there weren't frequent trades, right? Because, the percentage goes down the more frequent they are, right? So first 3 trades, losers. I get an email from a woman who said she put 33% of her capital in each one of the first 3 trades. And then she went all over online saying, this service sucks. Bobby's terrible. He doesn't know what he's doing. I don't believe he trades. Next 7 trades, winners.
Right.
And
so
you could do that percentage in your head, right? Yeah.
That's another thing. And my entire trading career, even before I got into the education business, when I was, a young buck and I was explaining this to my parents, my family, I would always really cringe and have to bite my tongue when someone would compare it to gambling, compare it to a casino. However, when you give out those kind of stats, Bobby, like you were saying, this has back tested 67% of the time.
Mm-hmm.
That's like the house in Vegas saying,
right.
With all games taken into consideration, we're going to win 52 or 52.5% of the time.
Yep.
You may lose the first 15 bets, right? But over time, that's the average. Well, that's the same in our business right now. It's the exact same in our business. So that's why sizing appropriately is of the utmost importance.
That's big. It's funny you say that because anytime someone has said you're gambling, I've said, rather than try to explain to them I'm not gambling, I've said, well, maybe, but I'm the house.
Exactly.
I can actually put things in my favor. And over time, as long as the other traders keep playing, which they always do, I'll be up over time. Just like the house.
And that would be my response also, especially trading back down on the floor.
Right.
Not only were you the house, but when you were trading on the floor, your edge was pretty massive.
Yeah, you're the house and the counting room.
Yeah.
Scotty, thank you so much for being here, man. I'm sorry it took so long.
My pleasure. Love it.
Yeah, we need to get back regularly. I know your schedule is tight, so we will try and arrange it again. Scott Bauer, Prosper Trading. Tell them again, please.
ProsperTrading.com. And there's the closing bell.
Good to see you, buddy. Thanks, guys.
Have a good one, Bobby. Great seeing you.